Hello again, everyone. The title of this video was established before the recent downturns that we had seen in the markets, but the content, I believe, is still very applicable. Despite recent corrections that we've seen in markets, prior to those, the stock markets in the United States, as represented by the Dow Jones Industrial Average and the Standard & Poor's 500, had attained record levels. So the questions become, how much is too much, how much is too fast, and it's a perfectly legitimate concern. The belief here is that the market levels we've seen are justified, and I think it speaks to how wildly undervalued they had been, just as I persistently reminded anyone who would listen for the past nearly 5 years. For example, the S&P 500 had recently hit 1650. It's a little bit below that as we speak now. The earnings yield of those 500 companies was just over 6%. The earnings yield is calculated by dividing the trailing 12 months earnings by the index price. So if you compare an earnings yield of 6% with other yields that are available, for example, that of the 10-year Treasury bill, the earnings yield of the S&P 500 is over 3 times that of the Treasury bill. It's pretty compelling. In addition, according to the June issue of Nick Murray Interactive, the dividend yield of the S&P 500 is over 1.9%. So the dividends alone that those companies are paying is very close to the 10-year Treasury bill. So investors are being nicely compensated, in other words, to the tune of just about what the 10-year Treasury bill is, for putting up with the volatility that we see in the stock prices. So as markets climb to new highs, and as they periodically adjust and correct at some point, as we've started to see this week, based on the lessons that we pass along over many years, there's no use fretting over when these times will come, as they will come and they will pass. So please contact me with any questions that you may have. Thank you.